Today we're going to discuss the balance sheet, everything about the basics of a balance sheet, how to read a balance sheet, evaluate a balance sheet, and we'll also cover a little bit about understanding a capital structure. So let's jump right into some definitions. A balance sheet is a statement of the assets, liabilities, and capital of a business. So it is one out of three documents that a company releases to the public to give the public an understanding of their current financial position. So a balance sheet is one of the first documents that any investor looks at. A few more definitions that's important for us to understand is current and non-current assets. So if a company can liquidate an asset within 1 year, that is known as a current asset. If a company takes longer than 1 year, that would be listed as a non-current assets. A few examples would be intellectual property, plant, and any kind of equipment. Here is what we're going to learn in this two-part series. So we're splitting this video into two parts, part A, part B. In part A, which is this video, it will cover assets, all current assets, net receivables, inventory, non-current assets, equity, goodwill. You will get a complete understanding of why certain things are documented as current assets and certain parts are documented as non-current assets, and also a complete understanding of goodwill and how an asset is depreciated. So that's part A. Part B will be current liabilities, long-term debt, deferred revenues, shareholders' equity, common stock, retained earnings, and both these parts together will give you an understanding of how to read parts of the balance sheet. Alright, so let's jump right in. Today we're looking at Apple's balance sheet. We're going to focus on their annual numbers and their latest 2019 figures. So, few things to note. One is that you can use other tools, not just Yahoo Finance. You can use Wall Street Journal, investing.com, or even Google Finance. Sometimes not all the information about what property, what plant or equipment listed might be in the balance sheet. So you will have to look at their annual reports and any other information that the company releases. To take it a step further, you'll also have to check how they're sorting these numbers. So in Apple's case, all numbers are in thousands. So when you see that cash and cash equivalents are $48 million, that actually means it's 48 million thousand, which is $48 billion. And other short-term investments are once again $51 billion, right? So that total cash is about 100 billion. Now, net receivables, inventory, and other current assets would equal a total current asset balance of 162. The net receivables is the amount of money that Apple will receive in that financial year, and their current inventory is being valued at 4 billion, and their other current assets are being valued at 12 billion. To take it a step further, in case you want to find out what these other current assets would be, you will have to look at their annual reports or any other releases from the company to find out that information. Now let's look at their non-current assets. So assets like property, plant, and equipment total to up to $95 billion, and the depreciation from the gross property, their plant and equipment, is about 58 billion, leading them to a total, which is the net, about 37 billion. Now, if you look back at the current assets tab, you can see that $162 billion worth of assets can be liquidated and converted to cash within a 12-month period. But the reason that property, plant, and equipment are listed under non-current assets is because Apple is not liquidating them, and these are long-term assets, right? So after depreciation, we get a total value of $37 billion worth of non-current assets. Depreciation is when the value of your asset drops over time. You can see here that out of $95 billion worth of property, plant, and equipment, Apple has depreciated over 58 billion. And we have now arrived at a net value of 37 billion. Now, think of this as buying a smartphone or a television or a house or a car. The value of your asset depreciates over time. And Apple has arrived at their net property value by accounting their depreciation and reducing 58 billion in value. Now, the challenge with Goodwill is that it is valued based on the perceived value, not on the real value. So let's jump on over to Investopedia to understand the definition of Goodwill. So Goodwill is an intangible asset that is associated with the purchase of one company by another. Specifically, Goodwill is the portion of the purchase price that is higher than the sum of the net fair value of all assets purchased in the acquisition and the liabilities assumed in the process. The value of a company's brand name, solid customer base, good customer relations, good employee relations, and proprietary technology represent some reasons why Goodwill exists. Now, to help you understand a little more, Apple is valuing its Goodwill at 5.7. Now, the meaning of that is Apple says that I have a good company and I'm going to value my company's Goodwill because of the brand name I've built in the market, the solid customer base, and good customer relations. To take it a step further, some investors do get confused between goodwill and intangible assets. Now, you will also notice that intangible assets and goodwill are indexed in separate columns. So, to take it a step further and understand this on a deeper level, goodwill would be customer loyalty, brand reputation, and other non-quantifiable assets. But when you talk about intangible assets, it's those that are non-physical, but they're identifiable, such as a company's proprietary technology, software, copyrights, patents, licensing agreements. So let me give you an understanding a bit further. Let's say a company is valued at $1 million and you are to buy that business and you're looking at the financials and you see that the book value is at 1 million, but you might have to pay a premium just because the goodwill or the standing in the market that the company has. The standing could be because of customer loyalty, so let's just jump back right in, and standing could be because customer loyalty, brand reputation, and non-quantifiable assets. Alright, thank you so much for watching. That's it for this video. In part B, you will learn how to understand the liabilities section of the balance sheet and put together both parts to get an understanding of the financial position of the company and the net worth of the company. So, thanks again for watching and hit that subscribe button.